Right now, in 2026, a retired school teacher in Ohio is paying $14,000 a year in income taxes she doesn't legally owe. Not because she made a mistake, not because her accountant got something wrong, simply because nobody ever told her that three specific accounts exist where her money grows completely outside of what the IRS can touch. Not tax deferred, not tax reduced, tax free permanently. Here's what most people miss entirely. Two of these three accounts have no annual limit on how much benefit they can generate for you over time. The IRS doesn't send you a letter when you qualify for something new, and your accountant isn't paid to find strategies that reduce their own workload next year. What I'm about to show you are three accounts the tax code already allows, already names by specific designation, and has allowed for decades. Yet most retirees don't discover them until after they've already spent years paying taxes they never had to pay. Before I go further, let me be precise about what I mean when I say these accounts are invisible to the IRS, because I'm not going to oversell this. The money in these accounts is invisible to the one thing that actually matters: your tax bill. The IRS cannot count a single dollar of it as taxable income. It doesn't show up on the line that decides what you owe. That's what invisible means here. Invisible where it counts? On your taxes? Here's the actual number most people don't think about. If you retire at 65 with $500,000 sitting in a traditional 401k or IRA, and you pull $40,000 a year from it to live on, every single dollar of that withdrawal is taxable income. At a 22% federal tax rate, that's $8,800 a year in federal taxes alone before your state even gets involved. Over a 20-year retirement, that's $176,000 sent to the IRS from money you already worked for, already earned, and are now supposed to be living on. The three accounts in this video don't reduce that number slightly. They change which of your dollars the IRS is allowed to count as taxable income in the first place. That's fundamentally different from a deduction or a credit. A deduction lowers the number the IRS taxes. What I'm describing removes the dollar from the conversation entirely. Let me be specific about what's coming, because there's an order to these three accounts, and the order matters. The first account works best if you're still working, even part-time. It has annual limits and income rules in certain situations, but done correctly, every dollar that goes in and every dollar of growth that comes out is completely untouched by the IRS. The second account is the one most financial advisors mention once and move past. It has a three-layer tax advantage that no other account in the entire U.S. tax code offers, and most people only use one of those three layers. The third account is different from the other two, and it has no contribution limit at all. If I explain that one first, the first two won't seem important anymore, so stay with me. Before I get into the first account, I want to ask you one specific question. Are you currently paying income taxes on money you're pulling from a 401k or traditional IRA in retirement? Just type yes or no in the comments right now, because the number of people who answer yes is going to show me exactly how many people this information is reaching for the first time. Type it now while I keep going. Also, hit subscribe and turn on the notification bell. What I cover on this channel tracks these exact tax strategies and how they shift year by year, because the IRS adjusts contribution limits, income thresholds, and qualified expense rules annually. The people who are subscribed find out before those limits change. The people who aren't find out when it's already too late to act for that tax year. Now, I told you the third account has no contribution limit, and it's the one almost nobody knows exists as a retirement strategy. I want to come back to that in a moment, because I need to explain why the first two accounts exist before the third one makes complete sense. Think about it this way. The first account is designed specifically for your investment income, the money you're growing for retirement. The second account is designed specifically for your health, one of the biggest expenses you'll face after you stop working. The third account is for everything else, the money that doesn't fit anywhere else, the money above every limit, the money that would otherwise sit in a regular brokerage account getting taxed on dividends every year, taxed on capital gains every time you sell, and taxed again when you pull it out. That third account handles that problem, and for a lot of retirees, it's the biggest pile of money the IRS is allowed to tax and simply doesn't. Keep that in the back of your mind as we go through the first two. It'll make a lot more sense when we get there. The first account is the Roth IRA. Before you click away because you've heard of a Roth IRA, I want to be specific about what most people get wrong about it, because the way most people use a Roth IRA and the way it actually works at maximum effectiveness are two completely different things. Here's how it actually works. A traditional IRA or 401k takes your money before the IRS touches it, lets it grow, and then taxes you on every dollar when you pull it out. A Roth IRA takes your money after the IRS already taxed it, lets it grow, and then never taxes it again. Not on the growth, not on the withdrawal, not when you pass it to your children. Never. That means if you put $7,000 into a Roth IRA this year and it grows to $70,000 over 20 years, the IRS sees $0 of taxable income when you pull that $70,000 out. That $63,000 of growth is completely invisible to your tax bill. The 2026 contribution limit is approximately $7,000 per year. If you're 50 or older, it's $8,000. That sounds small, but think about the growth, not just the contribution. $7,000 per year starting at age 45, invested in a basic broad market index fund averaging 7% annual return, becomes approximately $340,000 by age 70. Every single dollar of that $340,000 comes out in retirement with zero federal income tax owed. Here's where most people stop thinking about the Roth, and it's a mistake, because the real power is in two hidden layers. First, Social Security taxation. Most people don't know that their Social Security benefits can be taxed up to 85% if their combined income, including half their Social Security, crosses $34,000 as a single filer or $44,000 as a married couple. When you pull money from a traditional 401k in retirement, it pushes that combined income number up. When you pull money from a Roth IRA, it does not count. The Roth withdrawal is completely invisible to that calculation. Second, Medicare premium surcharges. Medicare uses your income from 2 years ago to set your monthly Part B and Part D premiums. If your income crosses certain thresholds, you pay what's called IRMAA, the income-related monthly adjustment amount. In 2026, that surcharge kicks in when your income crosses approximately $109,000 for a single person. A retiree pulling $50,000 a year from a traditional IRA on top of other income can land above that threshold and pay higher Medicare premiums. The same retiree pulling from a Roth instead keeps that income off the calculation entirely. That's a real dollar difference on your monthly Medicare bill every month for the rest of your retirement. Now, there's a rule. If you earn above a certain amount, you can't contribute directly to a Roth IRA. In 2026, that phase-out begins around $150,000 for single filers and approximately $236,000 for married couples filing jointly. Above those numbers, the direct contribution limit phases to zero. But here's what most people with higher incomes don't know. There's a completely legal workaround called the backdoor Roth IRA. Here's exactly how it works. You open a traditional IRA, make a non-deductible contribution, meaning you put in after-tax money and don't take a deduction for it, then immediately convert that traditional IRA to a Roth IRA. The conversion is only taxable on any gains that happened between the contribution and the conversion, which, if you move quickly, is essentially zero. The entire after-tax amount moves into the Roth IRA, and from that point forward, it grows completely tax-free. This is not a loophole. It's been specifically allowed by the IRS since 2010. Congress has had multiple opportunities to eliminate it and has explicitly chosen not to. Picture a 52-year-old marketing director earning $220,000 a year. She's above the income limit for a direct Roth contribution. For 20 years, she's been putting everything into a traditional 401k. She doesn't realize yet that every dollar she pulls from that account in retirement is going to be taxed as ordinary income. She does the backdoor Roth this year, contributes $8,000 of after-tax money, converts it immediately, and starts building the tax-free side of her retirement for the first time at 52. 18 years later, at 70, that money has grown inside a tax-free account. It comes out clean. None of it touches her Social Security taxation calculation. None of it triggers an IRMAA surcharge on her Medicare bill. Here's your exact action step. Open a Roth IRA at a brokerage like Fidelity, Schwab, or Vanguard. If your income is below the threshold, contribute directly up to the annual limit. If your income is above the threshold, open a traditional IRA alongside it, make a non-deductible contribution, and immediately convert it to the Roth. Mark that contribution as non-deductible on IRS Form 8606 when you file your taxes. That form is what protects you from being double taxed on the same money later. Every dollar that grows inside a Roth IRA instead of a traditional IRA is a dollar that will never inflate your taxable income in retirement, never push your Social Security into a higher tax bracket, and never trigger a Medicare premium surcharge. Done correctly starting today, this account alone can represent 6 figures of tax-free income in retirement that the IRS simply never taxes. That's the first account. I told you earlier that the second account is the one most financial advisors mention, but almost nobody actually uses to its full potential. The reason is specific. Most people use only one of its 3 tax layers and leave the other 2 completely on the table. Stay with me, because the third layer of its tax advantage is the one almost nobody knows about, and it's worth more in retirement than most people realize. The second account is the Health Savings Account, the HSA. If you've heard of an HSA and you think of it as just a way to pay for doctor visits with pre-tax money, you're using approximately 1/3 of what this account actually does. There's a reason it's called the only triple tax-advantaged account in the entire U.S. tax code. Most people burn 2 of those 3 advantages without realizing it. Here are the 3 tax layers. Layer 1, money you put into an HSA goes in completely tax-free. If you contribute through payroll, it avoids federal income tax, state income tax in most states, and Social Security and Medicare payroll taxes. That's a combined tax savings of 20 to 40% of every dollar contributed, depending on your bracket and your state. Layer 2, the money grows inside the HSA completely tax-free. If you invest it, and I'll come back to this, it compounds every year without the IRS taking a percentage of your gains. Layer 3, the money comes out completely tax-free when used for qualified medical expenses. No income tax on the withdrawal, none. Here's why the HSA is different from every other account. A traditional 401k gives you Layer 1 and Layer 2, then taxes you on every dollar on the way out. A Roth IRA gives you Layer 2 and Layer 3, but not Layer 1. The HSA is the only account in the U.S. tax code that gives you all 3 layers simultaneously. The catch is this. To contribute to an HSA, you must be enrolled in a high-deductible health plan, an HDHP. In 2026, that means a plan with a minimum annual deductible of approximately $1,650 for individual coverage or $3,300 for family coverage. If your current health insurance plan doesn't meet those minimums, you can't contribute to an HSA for that year. The 2026 contribution limits are approximately $4,400 for individual coverage and $8,750 for family coverage. If you're 55 or older, you can add an additional $1,000 catch-up contribution. Most people treat an HSA like a short-term medical savings account. Money goes in, doctor visit happens, money comes out. That's a valid use of the first tax layer, but you're leaving Layer 2 and Layer 3 entirely on the table. The real strategy is this. Contribute the maximum every single year, invest every dollar of the balance, pay your current medical expenses out of pocket if you can afford to, and let the HSA balance grow completely untouched. Here's why that matters. There's no IRS deadline to reimburse yourself from an HSA. If you pay a $400 doctor bill out of pocket today and keep the receipt, you can reimburse yourself from your HSA for that same $400 5 years from now, 10 years from now, or 30 years from now. The IRS has no time limit on HSA reimbursements as long as the expense was incurred after the account was opened. That means by the time you retire, you'll have accumulated years of receipts for out-of-pocket medical expenses, all of which you can pull from the HSA at any point, completely tax-free. That's a tax-free cash reserve you've been quietly building for decades, and the IRS never sees a dollar of it as income. Once you turn 65, an HSA functions exactly like like a traditional IRA for non-medical expenses. You can withdraw the money for any reason. Non-medical withdrawals after 65 are taxed as ordinary income, just like a traditional IRA, but there's no penalty. Before 65, non-medical withdrawals are taxed plus a 20% penalty. After 65, the penalty disappears entirely. So after 65, your HSA is either a completely tax-free account for medical expenses or a standard retirement account with traditional IRA tax treatment for everything else. It's the only account that serves both functions, depending on what you need. Here's the number that puts this in perspective. The average American couple retiring today is projected to spend over $300,000 on healthcare costs in retirement, not counting long-term care. Every dollar of that $300,000 that comes from an HSA, zero income tax. Every dollar of that same $300,000 that comes from a traditional IRA, taxed at your ordinary income rate. At a 22% tax rate on $300,000, that's a $66,000 difference in taxes paid or not paid on the exact same medical bills. Picture a 45-year-old nurse enrolled in a high-deductible plan through her hospital. She starts contributing $8,750 per year to an HSA for herself and her husband. She invests the entire balance in a low-cost index fund. She pays all current medical costs out of pocket and keeps every receipt digitally. She does this for 20 years until she retires at 65. Total contributions, $175,000. At a conservative 6% annual return, that balance has grown to approximately $320,000. She's also accumulated $40,000 in historical receipts she can reimburse tax-free at any point. She retires with a $320,000 tax-free medical account and a $40,000 tax-free cash reserve, both sitting in the same account, both completely invisible to her tax bill. Here's your exact action step. Call your health insurance company and confirm your current plan qualifies as an HDHP under 2026 rules. Open an HSA with a provider that allows investment of the balance, not just a cash-only account. Fidelity, Lively, and Health Equity all offer investment options. Contribute the maximum amount every year and begin keeping digital records of every out-of-pocket medical expense from the day the account is open. Every receipt, every copay, every qualifying expense. The HSA is the only account where money can go in tax-free, grow tax-free, and come out tax-free, all three simultaneously. In retirement, where healthcare is often the largest unpredictable expense, having a six-figure balance where every dollar pays medical bills without the IRS seeing any of it is a fundamentally different retirement position than the one most people are building toward right now. That's the second account. Here's the problem those two accounts still don't solve. The Roth IRA has an annual limit of roughly $7,000. The HSA has a family limit of around $8,750. Together, that's roughly $16,750 per year of money that can go somewhere tax-advantaged. What happens to the rest? What about the $50,000, the $100,000, the $200,000 sitting in a regular brokerage account being taxed on dividends every year, taxed on capital gains every time you sell, and taxed again in retirement when you pull it out? The third account handles that, and almost nobody uses it because almost nobody knows it exists as a retirement strategy at all. The third account is the one I've been saving, and it's different from the first two in one important way. The Roth IRA and the HSA are accounts you put money into. This third one isn't an account you open. It's a rule, a bracket that already exists in the tax code that lets you pull money out of your regular investments and pay the IRS absolutely nothing on the gains. It's called the 0% long-term capital gains bracket. And most retirees have no idea it exists, or they assume it could never apply to them. They're wrong. For a lot of retirees, this is the single biggest pile of money sitting in plain sight that the IRS is allowed to tax and doesn't. Let me explain exactly how it works. When you sell an investment you've held longer than a year, a stock, a mutual fund, an ETF, in a regular brokerage account, the profit is called a long-term capital gain. And the government taxes those gains at special rates that are lower than the rates on your regular income. Most people know about the 15% rate, What they don't know is that there's a rate below that, a 0% rate. That's right, zero. Not deferred, not reduced, not pay it later. A real, true zero. If your income is below a certain line, you can sell appreciated investments, take the profit, and owe the IRS nothing on that gain. It is, in every way that matters, invisible to your tax bill. Here are the exact 2026 numbers. If your total taxable income, and this is after your standard deduction, stays at or below $49,450 as a single person, or $98,900 as a married couple filing jointly, then your long-term capital gains are taxed at 0%. Here's why this is so powerful for retirees specifically. Think about who has low taxable income but appreciated investments. It's retirees, especially in those early retirement years after you've stopped working, but before Social Security and your required minimum distributions kick in and fill up your income. In those years, your income drops dramatically, and that creates room underneath that 0% ceiling where you can pull capital gains out completely tax-free. Picture a married couple, both 66, retired. They're living on $35,000 a year from a pension and a little dividend income, say $40,000 of gross income total. After their standard deduction, their taxable income is well under that $98,900 ceiling. In fact, they've got tens of thousands of dollars of room underneath it. So they sell appreciated stock they've held for years, stock with a $60,000 gain built up inside it. Because that gain stacks on top of their low income and still lands under the ceiling, they pay the IRS $0 in federal tax on that entire $60,000 gain. $60,000 of profit, zero federal tax, because they understood where the line was and they stayed under it. That is money the IRS is legally allowed to tax and gets none of. Here's the part that turns this from a one-time trick into a repeatable strategy, and almost nobody knows this. When you sell that stock and take the gain at 0%, you don't have to stay out of the investment. You can turn right around and buy it back immediately. With losses, there's a rule called the wash sale rule that makes you wait 30 days, but that rule only applies to losses. It does not apply to gains. So you can sell to capture the gain at 0% and rebuy the same investment the very next day. Why would you do that? Because it resets what's called your cost basis to the new, higher price, which means all that appreciation you just locked in at 0% is now permanently protected. The next time you sell, your taxable gain starts from the higher number. You've effectively erased years of built-up taxable gain without paying a dime for it. This is called tax gain harvesting, and in every low-income year of your retirement, you can do it again. Reset a little more each year, tax-free, as long as you stay under that ceiling. Let me be straight with you about the boundaries, because this is where people make mistakes. First, the gain stacks on top of your other income. So the question isn't what do I earn? It's how much room is left under the ceiling after my Social Security, my pension, and any IRA withdrawals are counted. If those already push you near the line, you have less room than you think. You have to do the math each year. Second, and this connects back to everything else in this video, realizing a big gain raises your income for that year, and that can have side effects. It can make more of your Social Security taxable. It can push you into an IRMAA surcharge on your Medicare 2 years later. So you don't want to accidentally blow past the line chasing tax-free gains and trigger a different tax somewhere else. Third, this is the federal rate. Your state may still tax the gain. If you're in a state with no income tax like Florida or Texas, you're clear. If you're in a high-tax state, factor that in. And fourth, the investment has to have been held longer than 1 year to count as long-term. Sell something you've held less than a year and it's taxed as ordinary income, no zero bracket. None of those are reasons not to use this. They're reasons to do it carefully, ideally with a quick projection of your income each fall before you sell. Here's exactly what to do. Before the end of any year where your income is lower than usual, especially those early retirement years before required minimum distributions, sit down and estimate your taxable income. Subtract your standard deduction. Then look at the gap between that number and the 0% ceiling, 49,450 single, 98,900 married. That gap is the dollar amount of long-term gains you can sell tax-free this year. Sell appreciated investments you've held over a year up to that gap. If you want to keep the position, buy it right back the next day to reset your basis higher. And if you're not sure where your income lands, this is exactly the kind of thing a fee-only advisor or a CPA can project for you in an afternoon, and it costs you far less than the tax you'd otherwise pay. A retiree who ignores this bracket sells their investments whenever they happen to need money and pays 15% on every gain year after year. A retiree who understands this bracket times their sales into their low-income years, harvests gains at 0%, resets their basis higher each time, and can pull tens of thousands of dollars of gains out completely tax-free over the course of their retirement. Same investments, same money. The only difference is knowing the line exists and staying under it. That gain is invisible to the IRS, exactly where it counts, on the one line that decides what you owe. Here's what all three of these accounts have in common, and this matters specifically. None of them are tricks. None of them are loopholes waiting to be closed. They are written directly into the U.S. tax code. The Roth IRA has been explicitly allowed since 1998. The HSA has been part of the tax code since 2003, and the 0% capital gains bracket is written into the tax code at Section 1, Paragraph H, with the income limits reset by the IRS every single year. These are not new strategies. They're strategies the financial industry has no strong incentive to walk you through proactively, because the money you protect in a tax-free account is money that isn't generating management fees somewhere else. To review one final time specifically, the first account, the Roth IRA, removes your investment growth from the IRS permanently, protects your Social Security from higher taxation, and shields your Medicare premiums from income surcharges. The second account, the HSA, is the only triple tax-advantaged account in the U.S. tax code. Used correctly as an investment vehicle, not just a short-term medical fund, it builds a six-figure tax-free reserve for the largest expense most retirees will face. The third account, the 0% capital gains bracket, lets you sell appreciated investments and pay zero federal tax on the gains in any year your income stays under the ceiling. Time it to your low-income retirement years, reset your cost basis higher each time, and pull tens of thousands of dollars out completely tax-free. Share this video with anyone you know who's still putting every dollar of their savings into a traditional 401k or a taxable brokerage account, believing that's the only option. One conversation about these three accounts before retirement is worth more than any tax strategy attempted after the money is already gone. Subscribe, share this with that specific person today, and I'll see you in the next one.